Hi everybody, it's Marco Byrne from GoldCore.com, your precious metals specialist, and I recently caught up with one of my favorite people in the precious metals industry, Mr. David Morgan, aka the Silver Guru. Really like David. I just find him very, very honest and a lot of integrity there, and he is really about protecting and growing the wealth of his clients, and that's been his raison d'etre for many years, as it has been ours. So we spoke about the latest developments in the silver market and the wider precious metal markets, and basically the outlook in both the coming months and the coming years as fiat currencies continue their decline into oblivion. And basically David told us about how he feels it's his duty to educate as many people as possible about the risks coming from the current monetary system, the current fiat monetary system. So it's an interesting interview, and David is as insightful as ever. So I hope you enjoy it. David, it's great to have you on with us again.
Well, Mark, it's great to be with you again, myself, and thank you for the kind introduction.
Absolute pleasure. So we'll get straight into it. Interesting times in both the gold and silver markets, and there's a lot of people talking about how this time is different. We've had a few false dawns in the gold and silver market in recent years, but we appear to have broken out. It looks quite convincing at this stage, particularly on the gold side, and silver seems to be playing catching up at this stage. So silver's up 9% in a month in July. I'm just going to share my screen. Yeah, so when you see that chart, I mean, you can see the massive move up 2009 through 2011, 2012, massive bear markets 2011, 12, 13, 14, 15, and we're slowly coming out of it. So it's interesting when you look at the gold price, it's broken out as well. That's the 10-year on a monthly, and then we've got the silver price, which seems to be obviously it's got a way to go in terms of catching up, you know. So, but the bottom line is a lot of people are talking about both precious metals are breaking out, and just that something's different in the market this time, and we'll drill down into the data now in a second. But what's your sense of it? There does seem to be some real fundamental factors that weren't there in recent years. So what do you think?
Well, my thinking is that we needed to break the 1350 level in the basis US dollar, because gold has actually done quite well in terms of other currencies. I mean, if you look at gold price in Canadian dollars, Australian dollars, gold actually has performed. But in terms of US dollars, gold has been languishing for quite some time. So we had this basically overhead resistance of 6 years. Whenever you break through a level of resistance that's that profound, you want to, one, make sure it's a breakout, not a fake out, and two, it's significant as long as it holds. So right now, based on the volumes that it took to get it through that level and the amount of people that were buying, I'm pretty convinced it's different this time, meaning that it's going to hold that level or higher. And we got a pretty good run. I mean, we went from like 1350 to about $100 higher in US dollar terms. And now we're kind of consolidating around the 1420 level. So I think what's going to happen is we're going to see a trading range for a while, probably between, I'm going to guess, it's a guess, 1420 to 1380, something like that. And the market will test the breakout. Now, this is the most important thing I can say on this interview is right now the commitment of traders shows an open interest of over 600,000 contracts gold. I checked data just before our interview, and we've only been at that level of open interest in the last 5 years about 4 times or so. And in every case, once the sell-off began, well, let me restate that. In one specific case, when the sell-off began, the gold price consolidated at a high level for quite some time. But it eventually broke to the downside and went down to what I consider to be the kind of minimum open interest level, which is about 400,000. And when that happened, if you go looking in the past, which gives us a clue about the future, but not necessarily an exact, premonition, It did sell off. So let me be a little more specific, Mark. When the sell-off starts, that's going to tell us how strong this market is. So if the market pushes down to 1380 and it bounces off, consolidates and starts back up, we've got a strong market. If it goes to 1350, 1360, the breakout point, and it holds that level and comes back up, we know for nearly certain that we are in a new bull phase. If it goes below 1350 and the volumes are high and it stays there for a significant amount of time, which in the futures market means a matter of 5 trading sessions, then we've got to rethink this. Now, I'm more bullish than ever that it's real, it's a breakout, not a fake out, because silver has finally confirmed the gold move, which means that we've gone from a gold-silver ratio of 95 to 85 in basically a cat's whiskers worth of time. I mean, a very short period of time. It shows you how fast the silver market can move.
Let me show that gold-silver ratio to people just so they know exactly what you're talking about. So, and we'll get into then some of the gold holdings and the silver holdings here, which is ultimately driving the price move. So as you said, this is on the, can you see that there, David?
Yeah, I can. You might want to expand it if you can. I don't know if you can, but
I think I can,
it's gone from 95 to
95 up there, yeah. 95. This is probably a week old, so these are the excellent charts that our friend Nick Laird provides from goldchartsrus.com. And as you said, it's gone from 95 to 85 just in the last 2 to 3 weeks. As I said, it's up 9% in July alone. So, I mean, when you look at that long-term gold-silver ratio, it's it's only been up at these levels back in, what was that, 1992, was it?
Yeah, in the 90s. I can't read the exact date, but we could look it up. But yeah, the chart shows basically.
It's 91, 92.
Early 90s, yeah.
Mm-hmm. Yeah, I think it was 1991. And then obviously back around the financial crisis, again, we got close to those levels. So, I mean, longer term, your view is we're going back down to what range do you think? Back to the
well, it's hard to say. I mean, biased and very bullish still. If you look at my earlier work and it's on the web and it's in writing, so I can't take it back, nor do I wish to. But I said when I wrote Engineering the Price of Gold and explained how you correctly determine the paper price of gold in US dollars or any currency for that matter, that it would be, at the time I wrote that article in the early 2000s, it was like 2,500 the ounce. Now the same ratio from the M1 money supply and the amount of gold the Treasury purportedly has, you're looking at over 10,000, believe it or not. That's how much money expansion we've had over the last 2 decades. So I looked at the gold price, which is easy to figure out, dollars per ounce. It's a division problem. Amount of dollars out there in M1, amount of gold in ounces, that's the price per ounce. Now, taking that basis, how do you project the silver price? Because silver is really not a monetary asset in the sense that gold is. So I looked at the historic ratio, the monetary ratio, and the natural ratio. So I looked at the 80 to 1, which is when I started the original website. I said, this is too high. Silver is the cheapest it's ever been, ever, in inflation-adjusted terms. Ever. I mean, it was cheaper in real terms at the 450 level than it was 22 cents in the Great Depression. If you don't understand what I'm saying, then do a little study. What I'm saying is, in terms of real, not nominal price, I know the number 450 is bigger than 22 cents. What I'm saying is that in purchasing terms, it was actually the cheapest it's ever been. And that's when, of course, the billionaires came in, not the millionaires, the billionaires. Buffett, Bill Gates, George Soros, all took silver positions in different forms. It was, Buffett took physical, which I know we're going to talk about what Mike Malone had to say about that. Yeah, Buffett, really moved the market, at least temporarily. And then you had Bill Gates that did it through Money Manager and bought a slug of Pan American silver. And then George Soros was instrumental in the APEC.
And it didn't move up as much as
touted to be a silver mine. So
it didn't move up as much as you think it would have, which suggests that even then potentially there was manipulation going on because the scale of that demand was huge. The price should have gone up much more given the scale of that demand from those 3 individuals alone, But it did. There was a bit of a spike up, and they seem to get under control again. But sorry, I interrupted you. Keep going.
So we're at a point now where we see these tops in the gold silver ratio, and they don't last very long. And we also see where they come down to. And if you look at what happened in the in this bull market, where silver really accelerated in April 2011, we got down a ratio of about 36-1. I believe it's the exact number. You can look at the chart that you're showing right now. So what do I expect was your question. The answer is I expect it to do at least that well, if not better. I do think it's possible to see what I call the monetary ratio, which is 16-1, which is not the natural ratio, is how it comes out of the ground. It comes out of the ground at a level about 9-1. And I suggested in that Engineering the Price of Gold article that to determine the price of silver is a lot more difficult than gold, but yet, and I'm saying the theoretical price, yet it could get to the natural ratio, which would be roughly 10-1, 1/10 the price. Now, if you look at this chart that you have, which is very useful from 1970, you see that, it hit that 16-1 back in the 1980 hunt debacle, we'll call it. Very, very, very brief. So
850 divided by 50, yeah.
Yeah. So I think we're going to see somewhere in the like 30 or better is my answer to your question. And the other part of it is we are in a situation where I think we're getting near the end game. And David, what do you mean by the end game? The end game is where we can only pretend and extend Jim Sinclair's words a little while longer. We could pretend that the bond market is solvent and it's solid and it's a reflection of an investment.
Real world demand.
Has low risk, which it's an absolute lie that the bond market has low risk. About the riskiest thing you could possibly do is put your money into a negative yield, get back less than you put in. What kind of thinking is that for an investment? And secondly, will you ever get paid back? And the answer is most likely you will get paid back. But when you get paid back that $1,000 face value bond or 10,000 or 10 million or 10 billion or 500 billion, what is the value of that money, quote unquote money, of that currency? And the answer is it is not guaranteed not going to purchase what it would have when you put the money into the bond, especially if you're talking the 10-year or the 30-year. And everybody knows it. The banks know it. The public knows it. The brokerage houses know it. But everybody pretends that bond investing is the safest thing you can do. When the safest thing you can do is you could go to a currency or a money that's never failed ever throughout history. And you can go to gold and silver as well and have something that's never, ever, ever failed. And yet people say it's wrong, it's too volatile, it's, there's too much
relic.
And
doesn't yield anything.
And it's not safe. It's not a safe investment. And this is where their thinking is absolutely 100% completely wrong. And here's why. Because gold, for an ounce of gold, a troy ounce of gold or silver, a troy ounce is the same mass everywhere in the universe forever and always. That's a constant. It doesn't change. And that's what you want in a money. You want a money that is solid, that you can rely on from here to eternity. I mean, that's the theoretical perfect money. So that's what gold actually provides. But what happens is it's priced in different currencies. It's priced against the US dollar, the Aussie dollar, the Canadian dollar, the euro, and everything else. And what gold is reflecting is the inconsistency, the instability of the currency system. The bond market, basically, the debt markets, because all money is debt. So what gold is reflecting is how undeterminable the value of a US dollar is in the future, or the yen, or anything else. But gold remains an ounce. So the thinking is absolutely backwards. And it's one of my, I think, most important ideas to be on the planet, because I feel called to this. I feel it's my duty to educate as many people as possible, that you've got to get a paradigm shift in your thinking. All gold is doing, sitting there as a solid piece of metal, is telling you that there's a huge uncertainty in the debt markets and the currency markets. Because the reason the price fluctuates is because gold changes. It's because the belief in the currency systems change daily. That's why.
Yeah. Absolutely, I couldn't agree more, and you summed it up very, very well indeed. And you can actually see that to a degree in this chart, particularly the top part. So, you know, people talk about gold, as you said, gold price in dollars, and is the price going up, is the price going down? That's just a reflection of what the dollar is doing and people's faith in the dollar. And ultimately, when you look at this chart, it's not that gold is going up per se, it's that the dollar, the euro, the pound, all these fiat currencies are losing time over time, losing value, should I say, over time, you know. And that chart there, when you look at gold and silver from the year 2000, so in around this level here, basically gold and silver 2000 through to 2011, 2012, massive bull market. And it's, again, not that they're going up per se, it's in that period of time people were losing faith in the dollar and the euro and the pound. They managed to come in with quantitative easing, and they managed to, I mean, it's bizarre. They printed trillions and trillions and trillions of dollars, euros, and pounds. So the gold price should have kept going up, but they managed to, they managed to cap the prices. We know, manipulate the prices lower, cap the yields, push the bond prices higher by buying them, and cap the yields, and they managed to get gold and silver lower. But ultimately, you can see the long-term trend is still these currencies losing value. We've had I think this will be seen as a mere blip in you know, over a 50-year period or a lifetime, or you know, over hundreds of years. This will be totally forgotten about, and this little recovery we've seen in the last 6 years in these fiat currencies, you know. So right. And we're now just on the verge of going back to that trend that we saw from 2000, and the trend we've seen throughout history, you know. So so it's interesting, and there when you look at silver, I mean, just look at the how undervalued it is vis-a-vis gold. It's, I mean, and when you say that, people go, okay, yeah, big deal, but it's gold is massively undervalued vis-a-vis stocks and bonds, yeah, which are at all-time record highs, and S&P at all-time record highs. And if it's funny, people they talk about buy low, sell high, when they seem to apply that to everything except when it comes to precious metals, you know. And they've been low for 4 or 5 years, and people are giving out saying, oh, it's low, and you said it was going to higher. So they're like, well, you've had a gift, you should be accumulating, and but instead, you know, and they don't get it. But it's funny, that chart, when you just look at it, it's gone from right to left. It's, you know, yeah, gold and silver in the last 6, 7 years, and everything else has gone the opposite direction. And you see that very, 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 very clearly in this, and it just creates a massive opportunity, because all these assets, as we said, we have the everything bubble. They're all at all-time record highs, and these assets are massively undervalued, both in nominal terms, but also, as you mentioned before, in terms of inflation-adjusted terms, you know. So let's look briefly at what is driving the prices higher in terms of the fundamental demand that is there. Obviously, there's a lot of you know, speculation on the COMEX, and the futures market can push prices lower in the short term. We've seen quite a bit of that in recent years. But ultimately, you know, the real world supply and demand of the 7 billion people on this planet for these finite and very rare precious metals will ultimately dictate the price. So, yeah, Mike Maloney, you mentioned Mike there. He did a good video there saying that something big is happening, and it most probably something big is happening in the silver market. And he brought up the charts from Nick Laird here, and you can see it very clearly. That big move up, a lot of accumulation in silver, particularly in the last month to 2 months, you know. And it was sort of you can see it. It was sort of lagging both in price terms and also in terms of accumulation. But that's a big spike there, and you can see it particularly in the weekly change down here on the bottom right-hand corner, and then you see it also in the transparent silver holdings. So the big move in the last year, 2 years, is on the blue here, which is the the green is the SLV, this light green color here. So there's obviously quite a bit gone into the SLV over the years. And then more recently, last 2 or 3 years, quite a bit of acquisition of silver holdings on the COMEX itself. So, and when you look at that trend since 2007, it's interesting. While silver fell from $50 back down to, you know, a low of whatever, $14 or so, there was very little selling of physical silver, you know. It's quite an interesting, that chart in itself tells a bit of a tale, you know. It's been quite sticky when you look at that, and now it's begun to move up again. And one thing to say about this is transparent silver holdings, and as we know, you know, there are many multimillionaires and billionaires in the world hundreds of them today that there weren't. There was only a handful of them 30 or 40 years ago. We mentioned obviously Buffett and that, but there are hundreds and thousands of billionaires all over the world, particularly in China and in India and in Russia and in Asian countries. And these people are unlikely to be acquiring silver and bullion via these channels. And it just speak to me. Sorry, so Mike basically he talked about Ted Butler's view, Alistair MacLeod's view in terms of who is doing this buying. So what's your view on it? Because it isn't the retail investor. I mean, we're hugely busy. We had a record quarter in Q2, but a lot of it is repeat business. There's a lot of conversion business. A lot of people moving from ETFs into us and from competitors into our storage. But we're not seeing the retail investor suddenly buying into gold or silver. So what do you think is driving or who do you think is buying ultimately?
Well, right now it looks like it's big money. I mean, I mentioned the open interest in the COMEX, and then a lot of it's paper trading. There has been some good movement, as you're just showing on that chart. It's mostly been in the ETFs, and that's usually institutional type of buying. You've got the hedge funds that see this gold-silver ratio at 95. It's almost a gimme. They start to do either a spread trade, which means to go long silver and short gold, or just go long silver. So that's taking place. Silver's hit a resistance level right here, but a couple comments on Ted and Alistair and Mike. First of all, I haven't spoke to Ted in quite some time, but first of all, let me say something very positive about him. And that is, I think he's brought more as much awareness to the silver market as I have, if not more. Obviously, he studied the commitment of traders and been the #1 most instrumental and influential person on the planet to let people know the significance of the commitment of traders report. Having said that, I've had conversations in the past with all these gentlemen, and the over-the-counter derivatives market is larger than the COMEX market, the CME. What we see that, Ted talks about all the time, I talk about quite often, it's kind of part of the vernacular for the gold and silver world, is this commitment of traders report, which I'm not trying to belittle in any way. I'm just trying to paint the larger picture. And the larger picture is that the over-the-counter derivatives market, which is not transparent, nobody knows what the holdings are, is bigger than what we can see. So that means that, for an example, you could have a banking entity, one of the large 8 traders, that has a net short position on the COMEX, but in reality has a long position because they have over-the-counter derivative products that net out all their short positions on the COMEX. And if you total up the total that we can't see, they could be net long. And that's a fact. Now, whether or not that's true or not, I don't know. What I'm trying to get people to realize is that, as Alistair said in his article, it's sort of looking at the tail wagging the dog. You're only seeing the part of it. Now, again, to emphasize the importance of the COT, it is what determines the paper contract price of these metals. And that's what it's done basically forever. And it is manipulated. I wrote a whole chapter on it. In fact, really 3 chapters in the Silver Manifesto. And I have time to go into that, Mark. But if you're interested, you can buy the PDF version of the book. I'm not selling the hard copy anymore. I never really made a dime on it. I'm not whining. I did it for educational purposes, not to make money, really. But the markets are manipulated. And, of course, Ted's probably the most vocal about that of anybody. Having said that, it's interesting because Alistair said that it could be, and he did it not tongue-in-cheek, but he did it as a speculative exercise. I mean, he's not saying it's absolutely this. He says, what if it is this? And I'll stick my neck out because I'm not fearful of anyone, but I don't really like to step on toes because we're all on the same side. We all think we should own precious metals for differing reasons or differing amounts or whatever. So let's get clear on that. But I distinctly recall, maybe it's my old age or something, that, Ted and I years ago, and Ted had mentioned that he thought maybe the Chinese were in the market. Now, he may have changed his opinion and maybe I misheard him or I'm misstating it now. But Alistair saying, is it possible? I say it is the article that he wrote, which I just lost, but, the whale and silver or something along those lines. He's not saying it absolutely is. But if you look at what the Chinese have done over the years, it makes sense that they could be. I mean, if you go back in the history, the Chinese actually were exporting about 100 million ounces of silver a year out of China.
That's opium wars. Yeah.
And then they switched to being net buyers, where they were importing 100 million ounces a year into China. Well, that's a swing of 200 million if you do the math, because instead of 100 million going out, it goes to neutral, which is 100 million. Then you're buying 100 million positive, so it's really a swing of 200 million ounces. Further than that, the Silver Institute came out early on. In the early days, I was invited to speak at the Silver Institute's functions, and the Chinese had put together it was really a silver campus, you might say. It was an area that they were going to devote to studying the silver market, basically. And that
I remember that, yeah.
In China. And it never really happened, as to my knowledge. The Silver Institute, basically, I called them, and I'm still very friendly with some of them there. And, you know, as far as we can determine, it never really happened. Now, could have, and didn't, you know, make a big deal out of it. My point being is that they understand the technological aspects of this unbelievable metal that reflects light, heat, better than anything else. And they're quite concerned about the recycling of it and not wasting any of it. And this is on my personal journey over there to Beijing and meeting with CITIC and their metals division many years ago. But still the foundation holds. But they didn't really look at it as a monetary asset like I do and some others do. So coming back around to Alistair, Mike, and Ted, look, silver is an important metal for various reasons. I have a different view than probably all of them, but I don't think it's germane to this conversation. But we'll say a few things on Mike. Mike and I are pretty close, and Mike can handle it. But he said a few things that were almost perfectly accurate, but not quite. So when Mike talked about Buffett making the big buy, he did buy 129.7 million ounces of silver off the COMEX. And when he looked at that chart, he said, well, it looks like it all came off the COMEX. And it may have. What actually took place, though, just I want to get this off my chest, not that it's important to me, is that they only could deliver 90 million ounces, or I should say maybe that all they delivered initially was 90 million of the 130 million.
When you say delivered, you mean they transferred the ownership within the vault into his name. He didn't actually take delivery.
Yeah, he did at one point because it all went to London. It went to London.
Interesting.
And when London got 130 million ounces, they started the SLV. Isn't that a coincidence?
The plot thickens. I remember reading that before, actually.
Yeah, well, you know, I don't want to brag, and who's a silver guru? I take that tongue in cheek, but I do study the market pretty hard. And, you can have your opinion of me. Believe me, I got my detractors. That's fine. So here's what happened. He bought 130 million ounces. He immediately was delivered 90 million, and 40 million was basically on paper. And if you look at it, I wrote a whole big article about it. Unfortunately, I've lost it. I've changed computers so many times. But that 40 million ounces, the lease rates in silver went up to like 17%, which just makes Warren Buffett's mouth water, because he hates non-productive assets that don't throw off a yield. So with a silver lease, where he's got the silver on paper and he's able to lease it at 17%, he's in hog heaven, right?
Yeah.
It took about 2 years, Mark, for that 40 million to come off, and the lease rates went into these ridiculous numbers of like, 0.5% a year or 1/4% a year, or just these stupidly low lease rates. So then, the plot thickens, as you just said. I was lecturing or wrote, I forget which, about, how little silver. And this is years ago. I mean, these things vary. So we're not talking about today. We're talking about years ago. How little silver was actually in the European markets physically. And I got a phone call from someone that was pretty irate about me being wrong, because they'd just been to the warehouse, and he was kind of chewing me out. And, I can take it. So I got off that call and immediately called Jeffrey Christian at CPM, and I said, Jeff, going on your data here and blah, blah, blah. Well, Jeff's a pretty straight shooter. I'll defend him. I mean, I'm not like, we have different worldviews, but I certainly respect his thinking. And,
I like him. I met him, and he's
I've got
straight shooter.
nothing negative to say about him,
Mm.
really. But he started chuckling a little bit. He goes, "David, that's Warren Buffett's silver." Like, oh. So it was all transferred to London, at least the best I could determine. And then, as I just said a moment ago, and I want to emphasize it, Mark, is the SLV started with, isn't it amazing, 130 million ounces of silver?
It's a little bit too much to be a coincidence.
And Buffett sold his silver, $9, right? So he bought it at, maybe 5 and under, took delivery, finally got delivery after waiting a while. It all ends up in London, as best we can determine. He sells it out. Does he really? Or was he a participant in the SLV? And I don't know. I don't get too conspiratorial here. But the facts are what I outlined. He bought it. It took him a while to get it all. It ended up in London, and the SLV starts.
What year was that again? I'm just looking at the chart here. Because
I don't even remember. Let's see, it was
90.
It was like in 2000 or so.
98, 99, I think. Yeah. I think it's just a little blip we saw here. Went from $5 to $7 or $8
to like $8.50 momentarily, and then they exactly right back down to $5 or so.
Yeah.
My belief is, and this is conjecture or hypothesis, whatever, is once they determined he was going to get 90 out of the 130, and he took the rest on paper for a while. That was the ability for the exchange or the traders or whomever you want to name, banks, to move the market back down rather rapidly. And he was okay with that. I think he loved getting that 17% for a while. And I think he had his view on, when to sell, and, maybe got pressured, and maybe he did participate in the SLV. I don't know. I don't know any of that. It's all conjecture. What I do know is, what I outlined as fact that can be determined to a great degree. For yourself. You can do your own research and verify what I've outlined here.
Yeah, very good. Bottom line is that we can see it in the figures, there is very strong demand there, whether it's from the Chinese or Western high net worth, ultra high net worth billionaires. India is something as well. No one talks about India. The Indians have a huge cultural affinity for silver, nearly as much so as gold. And some people say it's even more towards silver. And they understand and value the Indians as well. And we have relationships with the big storage providers throughout the world, including those who store in India. And I know from people in certain companies that will not be named, but some of the biggest storage providers in the world, that there is a lot of silver being accumulated in India. And the question is it by Indian banks? Is it by Indian billionaires? Or is it even potentially by Western interests who are saying, well, why don't we store it in Mumbai? We might be safer having our silver stored in Mumbai than we would potentially in London or New York. But there is a lot of silver being acquired, and it's not being talked about, and we just don't know the data, And even this, when you look at this and the numbers on this here, the transparent silver holdings, it says total 1,069.695. Can you see that there?
Yes.
So you multiply that, and that's 1,000 million ounces. So you multiply that by $16. So what are we at?
16 billion. So you got 1 billion ounces of silver roughly. So that's 1 billion in the ETFs, the transparent silver holdings and holding companies, the COMEX. I mean, they're all spelled out there in a little column to the left. Yeah. So there's 1 billion. Then you've got roughly 1 billion ounces that's in coin form. That's not between government coins like the U.S. Eagle and the Canadian Maple and the Philharmonic and the Kangaroo series and everything else. If you add all those up, you come out with about 1.1 billion. So you add these two together, which is, the transparent holdings are basically commercial bars. So you got 1 billion ounces there, and you got 1 billion ounces in coins. So you got about 2.1 billion ounces that we can account for basically right now above ground that's investment grade silver. So that kind of gives you an idea of where the silver is. In other words, where is it all? Well, that's kind of tells a story. It's not really complicated. You've got all these entities spelled out on the left, and then you've got all the coinage that has been taking place. And that doesn't, of course, count for, what we call constitutional or junk silver, which there's actually very little of that left. Most of that is, been melted into bars, but there's still some available. And so if you add it all up, basically you're looking at, maybe at the most right now, somewhere in the 2 to 2.5 billion ounce range of investment grade silver. I'm not talking about, silverware or candelabras or art form or any of that, because there is a fair amount of silver in those, in those objects or whatever. And those could be turned into investment silver. I mean, you could certainly melt some silver candlesticks or silverware or whatever, but that's not what I'm talking about here. I'm talking about what is above ground right now, tangible, that's investment grade that you could sell through GoldCore, for example.
Yeah. So you're saying, just to get the figures right, so did you say $2.5 billion worth?
No, I'm saying 2.5 billion ounces worth. And
multiply that by the $16
Yeah. So right now there's, $16 an ounce, a billion ounces is $16 billion. So if you've got 2 billion ounces, which I'm saying is kind of the minimum, you've got 32 billion ounces is the entire complete total silver market above ground right now.
Yeah, no, it's tiny, and
it's infinitesimally small.
Yeah,
I mean, the number sounds big for you and me. I mean, who would want 32 billion? But I mean, in the scheme of finance,
exactly in the scheme of quantitative easing that we've seen in recent years, and the mood music now from the Federal Reserve and the ECB, indeed yesterday, is they're going back to so-called stimulus. They're going to digitally create trillions and trillions of euros, dollars, and pounds again. And in order to support the bond markets, and the bond market is absolutely massive. I think the estimate I saw recently was something like 50 trillion in the bond market, and it's negative yielding. So all it takes. These so-called balanced portfolios, 40 or 50% equities, 40 or 50% bonds, all it will take is a tiny 0.1 or 0.2% of those assets to go into silver go up 3, 5, 10 times, as it did during the last financial crisis, So,
well, silver, I got this from Jeff Christian did he does pretty darn good presentation as far as I'm concerned.
Yeah, I was at the conference, the Shanghai Gold Conference with him in Shanghai. He was very good.
Yeah, and so on one of these, was at the Silver Summit a couple of years ago, he pointed out that the financial wherewithal of the silver market is 0.02% of the financial assets of the world. And so, as you just said, Mark, I'm backing you up here, it would take, just think of doubling that to where the silver monetary value held by investors for whatever reason they determined for themselves became 0.04% of the world. And this is astonishing to me. I mean, of course, I'm a silver nut, but think about this for a second. 0.02% of all the world's money is based on silver, and everything else is, stocks, bonds, gold, real estate, not even real estate, excluded real estate. And go back 100 years and basically you're on a silver standard, And if it wasn't silver, it wasn't money. So you went from almost 100% silver as the monetary asset. I mean, now I know this is history, but it's still true, a true statement. To where now it's so unwanted and so unliked that it goes from basically should be 100% in the, until the crime of 1872. So in 1850, let's say, if it wasn't silver, it wasn't real worldwide, generally speaking. People bartered, I get that. And now it's like persona non grata. It isn't even a blip on a radar screen anymore.
Yeah, it's not even a barbaric relic. It's not. Yeah, exactly. It's been completely, and I suppose Bitcoin and cryptocurrencies, and that's a conversation for another day. They have taken the place of silver because when we were in the bull market, silver, a lot of our it was actually a younger client with more of a risk appetite, because the older client was worried about the volatility of silver, but the younger client saw silver as both a hedge and a safe haven and store of value, but also they saw the potential return on it. So, but the bottom line is it's the fundamentals of it in terms of supply, demand, how rare, how finite it is. And then, you were alluding to this before in terms of just, it's a natural form of money, and in the Earth's crust, is it, 15 parts of silver to every 1 part of gold?
No, 10 to 1.
Is it 10 to 1? Okay. So, and that's why they knew throughout history, the ratio was generally 10 to 15 to 1. You go back to Greek and Roman times through to Elizabethan England, throughout history, it was always around that, because that's how it came out of the crust, and the people realized, and the governments realized, this was roughly the ratio between the two, and so that's history. But we're not, history is not over. We have not seen the end of history. We just see quite the opposite. I think what we've seen in the last 20, 30 years is sort of would be seen as a giant monetary Ponzi experiment, whereby these assets were briefly forgotten by the masses for a period of time. But I think they're in for a fairly rude awakening fairly soon. So that gold silver ratio, I mean, you see it there even in the 1970s. I mean, the ratio was down, 20 to 1 up to 40 to 50 to 1. So I like you, I'm very confident we're going to go back there at some stage. The question is when. So and it's the smart money sees silver as fundamentally undervalued, and the value investors out there, and the Buffett's and the high net worth, ultra high net worth in America and in India and in China and Russia and all over the world. I mean, even Malaysia, Vietnam, there's a huge amount of money, particularly in these Asian countries, in Singapore and Hong Kong. And these people are looking at this and they see it as a massive opportunity, and I hear that from some quite connected people, shall we say, in the storage business, who are seeing these flows firsthand. So, okay, well, let's talk about, there's an opportunity here. So how should people be acquiring physical metals in your view, in terms of coins, VARs, and then your view in terms of potentially asset allocations at this stage?
Sure. First of all, for full disclosure, I have an account with Mark. We are friends, but I found, and I do my homework, as most people know, not that I'm perfect, and certainly I get things wrong. Usually when I do, I admit it. One thing I was wrong about, I want to kind of chime in, is on the cryptocurrency. I just want to come back to that real briefly. I did see and understand that a lot of this disgruntled silver bulls had turned their monster boxes or their bars into cash and gone into the crypto market. What I got wrong was the amount. A lot more of that took place than I initially thought. A lot of these people are younger and they're very aggressive and they're willing to take high risk for high reward. And a lot of that silver got put back on the market. So I want to make that clear. But coming back to your question, so there's really two ways to invest in the metals. And I'm going to do this not on dollar cost averaging or whatever we can talk about, but there's really two ideologies. The one ideology is you understand where we are with the fiat money system, and that debt is money, and that is a real danger for everybody on the planet that transacts in some type of currency. When you recognize that, then what you need to do is determine what's the right percentage for you personally to be hedged when or if that inevitability happens where this currency is no longer trusted, or we go into a high inflation, hyperinflation, or, God forbid, a Venezuela type of situation or whatever. So you buy a hedge, you pay for it in full, you either keep it in your house or home safe, or you store it at GoldCore or one of these situations where it can be trusted, because several of these places cannot be, or have shown they can't be. And I won't name names, but there's been like 3 or 4 over the last decade that have failed miserably. So you buy your, let's say 10% is what I recommend. I think that's what Jim Rickards recommends. And you forget about it. You buy it and you forget about it, because you bought it for one purpose and one purpose only. And that is that if everything goes to, excuse the expression, hell in a handbasket, you're protected, because that 10% allocation will go up about tenfold. And we've already seen that happen throughout history again and again and again. In fact, it could go up 20-fold, which means that you could lose everything on the other side, your stocks, your bonds, your real estate, your farmland, whatever, and that stuff won't go to absolute zero. But even if it did, in theory, that position in precious metals will protect your entire wealth position. Okay. Now, the other ideology is that, well, I want that protection, and I want additional funds in the sector because I think I could get capital appreciation as well as protection. And that's where most of your gold bugs come from. It's people like me that are overweighted into the precious metals, far above the 10% allocation that's most, let's say financial people will recommend as a hedge. you're going into more of a higher allocation, because not only do you think that we're maybe at the end of the line as far as fiat is concerned, but you also expect to see an overperformance in that sector vis-a-vis the other financial arenas. So you expect gold to outperform stock, you expect gold to outperform bonds, you expect gold to outperform real estate perhaps, or whatever. And there are times. So, one of the fallacies I would say about, the gold idea is, gold is a long, it's money, it's been money 4,000 or 5,000 years, it's never failed, all those things are true. And the idea, well, gold will buy, men's suit for all of history. Well, that's true more or less, but what I don't think is emphasized enough is gold, like any other asset, can be undervalued, fair valued, or overvalued. And it does vary in value. There's a time during the Weimar Republic where purportedly you could, use a gold coin and buy a city block of buildings. Now, I don't know if that's true or not, but at least it gives the idea that gold was extremely overvalued in that, currency crisis, panic, dissolution of the currency at large, where it was basically dissolved. And people sought the one asset that they trusted, which was gold. And they would take that gold in exchange, raw real estate at a rate that, comparing apples to oranges, or value to value is a better way to say it, that half a block or city block, whatever, for an ounce of gold. Are you kidding? Great buy for the gold person that bought that land, right? So I just want to emphasize there's times to invest, and there's times to buy and there's times to sell, even gold. And so,
or increase allocations and decrease allocations.
Absolutely. Yeah. So here's where we're at. We're very undervalued in gold. It's coming out of basically a 6-year consolidation. I'm pretty convinced this is for real, and that the debt markets keep getting more and more squirrely every day. And this idea that, we're going to make America great again, well, great idea. Let's see it. Show me, don't tell me, because we get blasted by the news over here that everything is good, hunky-dory, wonderful, and all this stuff. But I do a weekly perspective, as you know, Mark, and all my news, which I get off the mainstream a lot, Bloomberg and Reuters and CNBC and Market Watch and, some more obscure channels. But basically, the world is in a contraction. China has massive problems. And we need to be real with what's going on. And what's going on is more and more uncertainty in the markets. We're going to see a lot of pressure on food prices starting almost immediately. You're going to start to see food shortages over the next few years that probably will continue for a while, meaning not more than, a couple growing seasons. I'm talking probably maybe 3 to 5 years. And so we're going to get a real...
I'm hearing that a lot from clients and some quite, people who are involved at the coalface in terms of working in agriculture and in these resource industries. And a lot of talk, obviously climate change is a big part of this, we're all talking about. And are we going to have global warming or global cooling? And there's a whole debate going on there as well, So, I saw Armstrong only overnight. He was talking about, I don't know if you get his email, Martin Armstrong, he was suggesting it's the grand solar minimum that we're coming into a global cooling period, But one way or the other, it's beginning to impact the food supply already, and some of the crop data,
Yeah. So I guess we could wrap it up. You showed my website. Basically, I have 2 functions, really. One is this one, to educate the public as far and wide as I possibly can. I feel it's my duty. I feel it's my calling in life. And that is the free one that Mark's showing right now. Just give me a first name and an email. It is a double opt-in, which means if you make up some email, it's not going to work. You've got to have a valid email. It will send you a link and say validate that you really want this free letter, and you will get that. And then I have a paid service that you can go to the top of that page Mark is showing you, and you can go to the subscribe button and read our sales letter. And this is for sophisticated investors. And, if all you want is a position with, let's say, GoldCore, again, I am a client. And, I'm very happy with everything about GoldCore, really. But, you buy through Mark's company and you store it there, which is what I've chosen to do. And all you want is metal, then you just do that and forget the market report, really. I mean, you can get the free report and get the updates that I do and the interviews like this and, webinars that I do for basically education purposes, and you get my speaking schedule and all that. and that's all free. And then you can, if you're so inclined, and best leverage you can get is well-chosen, cash-rich, unhedged mining companies throughout the sector. We do not just silver and gold, but we do, all the elements you could think of. We were first on rare earths. We've done, the lithium thing, the cobalt, copper, zinc. We were first on a zinc company that had high leverage to silver. We doubled our money on that company, which was pretty hard to do during this bear market, to find companies that would double. And we've done that a few times. So that's what the Morgan Report's basically about. It's basically for equity investors. And I do trade, and I show my trades by video, Mark, and I'm a position trader, not a day trader. So, for example, when I saw silver down at this level, I said, if you were so inclined, watch it break through this level. I have a certain method that I use where it's nothing to do with me. It has everything to do with the market. And if the market says go long, then I go long. And I have certain rules, I call the Morgan rules, that I use so that the market is actually determining whether or not we should get in or out of a given trade. So basically, I have a core position about 70-75%, and I trade around with 20-25% to enhance the yields to my portfolio. And why do I do that? Well, the reason I do it is, one, I'm good at it, two, I enjoy it, and three, you'll get a better yield overall if you're able to position trade around these markets, because the volatility is so high. I mean, in my trading platform, I made about 30% here on this move when gold broke out. And many of the people that follow my work, our paid work, did the same thing. And now we've got either tight stops, or some people took profits vis-a-vis the fact the COT is looking rather much into the selling zone, or, we're in a buying zone or a selling zone basis the COT. Try to keep it real simple. Right now, we're more in the selling zone. Doesn't mean that we can't go higher. We could stay overbought for a long time, especially when we notice that gold is reacting positively, meaning it goes up on days where there's more geopolitical tension. You get one of these tankers in the Strait of Hormuz, and all of a sudden gold's up another $8. That's a very positive sign for gold, especially gold longs, because that shows that we are, more bullish than bearish. So I think I'm done, Mark. I certainly enjoyed the interview. I hope that all of your listeners and viewers got something out of it. I really do feel so strongly that everyone needs some, not all. The problem that I've found with my experience is somebody hears me or Mike Maloney or Ted or somebody, and they get the concept really, really well. In fact, they grasp onto the idea, with both hands, and then they overload and they buy it all at once. And they don't take any consideration into who to buy it from. And most people, that 5 or 10% allocation is enough, and just buy that and forget about it. Buy it from a reputable dealer. And, depending on what you're buying and what you want, if you want it, the reason I have GoldCore is because I want something outside of the U.S. jurisdiction. I mean, I'm plain and simple. That's what I teach for more sophisticated or high net worth investors. It's not necessarily right for everybody, but a lot of my clients want to have the same accessibility to something outside of the U.S. jurisdiction, if that's the jurisdiction that they're living in. And, I don't know how many clients I've sent you, but I know I've recommended, as far as being in a different jurisdiction, that you're one that I know and trust.
No, you have done, and I greatly appreciate that. And we've sent many clients our direction over the years. And ultimately it's about diversification, and only you need to have precious metals in not everybody, but anyone who has a high net worth, I believe, should have some of their precious metals stored offshore in the safest jurisdictions and in the safest vaults. And that's very much what we specialize in. I just do our own little plug briefly. We put a video there. We believe it's one of the most important videos we've ever done, because we really drill down into the importance of being, everyone talks about allocated and being fully allocated, but the segregation is actually the key thing, being fully segregated, because that greatly reduces the counterparty risk, and that confers. We actually create this acronym called SAFE, which is segregated, actionable, flexible, and expenses. Because a lot of people don't think about they always think about buying, and you've had this problem with people. They're always saying, oh, when's the best time to buy and when will we buy, and they don't think about, and then they try and pinpoint exactly when to buy and they try to pinpoint exactly when to sell. And it's just not possible for anybody. So why not dollar cost average into your position and dollar cost average out of position, gradually increase allocations, gradually decrease allocations when the price is overvalued. And I'm sorry, if you don't own any precious metals or any physical bullion, you should geometrically cost average. So you get that by 50% initially, get that initial position, and then you would buy the other 50% over a period of time. You know, when I say 50%, I mean of your precious metals allocation within the overall portfolio. You know, so in this video, it's for anybody who really wants to understand the importance of owning gold in the safest way as possible. It's something that we spend a lot of time on, and there's a lot of stuff in the gold market. You mentioned different providers, and there's issues now with people actually taking delivery of their gold, people trying to sell their gold and get their funds back, their dollars back, and they're being asked for proof of funds 10, 15 years ago. The expenses, the costs are actually being changed in the small print, and it's easy to buy very cheap, but then when you go to sell, it's not quite as cheap as it was 5, 10 years ago, and these things are changing. So it's important to always be testing the exits. You know, we talk about, you know, when you go into a theater, you know where the fire exits are, and you know exactly where they are, and they've been tested by the safety people. And it's the same thing with precious metals, particularly because they are your safe haven assets. You know, so to wrap up, David's a busy man. It's been great having you on again. Wish I had a bit more time, but we'll do it again soon, I hope. I'd encourage people to check out the Morgan Report, particularly anybody who is interested in both precious metals and natural resources, and there are huge opportunities in these sectors in the coming years. So you can sign up with David there. And then with us, we do our daily market update, which gets picked up quite widely, and you can sign up for that on our website, GoldCore.com. It's there on the home page. You have to scroll all the way down, but it's there, and you can sign up for our YouTube videos here as well. So let me stop sharing that. David, yeah, pleasure as always. You're great, and thanks for getting up early and joining me today. And have a great weekend.
Thanks so much.